Chapter D2, Complex Groups. Now the first thing to point out about complex groups is that the word complex here doesn't mean difficult. It simply means slightly more interesting groups. In fact, some people call them vertical groups, and that's possibly a more interesting name, because what a complex group is, very simply, is the difference between what we've done so far, where P might own, let's say, 90% of a single company, and instead of that, what you've got is P owning some shares in a company, let's say S1, who themselves own shares in another company, let's call them S2. And that gives us this so-called vertical or complex group. Now, there are just a few twists and turns that differ from a normal, simple group structure, but with a bit of practice, there can be some easy marks going here. And the first thing to acknowledge really is what we're dealing with. So I'm going to remind you that a subsidiary is any company which you control, and therefore P must prepare group accounts with respect to any subsidiary that it controls, whether directly or indirectly. So, for example, in the scenario you've got on the page here, P owns more than 50%, it owns 70% of S1, and so S1 is indeed a subsidiary of P. Now, the thing to bear in mind in this chapter is that everything we do is from P's perspective. Everything we do is from P's perspective. Most of the mistakes that can be made in this chapter essentially forget that we're looking at everything from P's perspective, because we are going to be preparing the P group accounts, incorporating all of P's subsidiaries. Now here, S1 is clearly a subsidiary of P. But also notice that S2, well, P controls S1 because P can tell S1 what to do. Now, because S1 owns most of the shares in S2, notice that S1 can effectively tell S2 what to do. And therefore, through this chain of command, P can control S2. P can tell S2 what to do by simply telling S1 what to do, and then by saying to S1, you control S2, go and tell S2 to do this. And therefore, through your chain of control, you can control S2 as well. So S2 is also a subsidiary of P. Yes, S2 is also a subsidiary of S1, but we're going to be preparing the P group accounts, and everything we do is from P's perspective. And hopefully you can see that through that chain of command, we do indeed control S2, and therefore S2 is a subsidiary. And that's it. But notice what we did not do there, and again, this is a very common mistake with weaker students, and certainly the first time you look at this you might have done the same as well, but what I did not do there is multiply 70% times 60%. If you multiply 70% times 60%, that gives you 42%. Now 42% suggests that this company is an associate being a company you own between 20 and 50% of. But that does not tell you whether S2 is a subsidiary or not. So be careful. You're falling at the first hurdle there if you make that mistake. To work out what S2 is, you simply ask yourself, do I control S1? And does S1 control S2? And if so, I, P, control S2. But actually, we do end up multiplying 70% times 60% to work out what we call over the page P's effective interest in S2, 42%. And indeed, we will use that 42% later on, but we don't use it to determine whether or not S2 is a subsidiary or not. And again, I make that point here in this tutor note. I don't want you making that error. One of the other things we're going to use that effective interest for, and what I'm going to just go back to our little diagram here and draw in, is that we are ultimately going to be looking at non-controlling interest. Don't forget, non-controlling interest is that part of the subsidiary that we don't own. So for S1, we don't own 30%. But there's also some non-controlling interest in S2, and you just have to be a little bit careful here. P, and don't forget, everything we're doing is from P's perspective. P doesn't actually own any shares in S2, but effectively, as we just saw, they own 42%. Now, if we effectively own 42%, then the non-controlling interest effectively own the other share, the 58%. Now that 58% is a bit odd because actually nobody owns 58% of that company. But we are going to use this effectively like a balancing figure in this chapter, so be careful there. Okay, well the second thing we're going to bear in mind is the dates, the date of control. So just moving on to this next illustration, you can see here that P bought S1 in 2005. Now at that date, S1 had already purchased its shares in S2. So in fact, when P bought S1, S1 already owned S2, and you could look at it really that what P was doing was buying the S1 group, or it was buying control over S1 and S2. But we're going to use these dates to work out when these two companies entered the P group. So for example, when did S1 enter the P group? Well, the answer here is that P bought S1 on the 1st of January 05, so that's when S1 entered the P group. I could also ask, when did S2 enter the P group? And again, keep an eye on the dates and bear in mind that when P bought S1, they also obtained control over S2. So hopefully you can see that S2 also entered the P group on the 1st of January 05. Not 03, because P didn't own S1 in 03, and therefore from P's perspective, we had no interest at all in S2 in 2003. Or what if I switch the dates around? Notice here that P initially buys S1 in 2006. So S1 enters the P group on the 1st of January 05. But then, subsequently, S1 buys S2. Probably because we, P, told S1 to go and buy S2. Don't forget, we control S1. And so, in terms of when S2 entered the P group, well, S2 entered the P group on the 1st of January 06. So you've just got to be a little bit careful as to these dates, keeping an eye on when these companies enter the group. Now, why do we care? Well, these dates will end up becoming important when we calculate goodwill. Because don't forget, goodwill is always calculated at the date of acquisition, i.e. when these companies entered our group. So we'll bear those dates in mind when we come to do our goodwill calculation. Now, you can see at the bottom of the page here, we've given you a goodwill calculation for S1, and we've also given you a goodwill calculation here for S2. Now, don't worry too much about these goodwill calculations for now. I'll show you these with some numbers in a moment. But notice that you are allowed to put the goodwill calculations side by side, if you like, just to save you writing out these words twice. And when we calculate what the reserves are for the subsidiaries, S1 and S2, we will bear in mind the dates the companies entered the group. And that's where we're going to use these dates that we just talked about. Well, let's see this with some numbers. So we have an illustration over the page with top, middle and bottom. And you're given some data relating to the share capital of these three companies, what their reserves were at 2003 and 2006, and you're asked to calculate goodwill arising if top bought 90% of middle in 2006 for 400,000 and middle bought 60% of bottom in 2003 for 100,000. You're also told here that we're using the partial method of goodwill. Don't forget the jargon that we talked about in chapter D1. And again, if you haven't learnt that jargon, do refer back to chapter D1 here. That's the jargon your examiner is going to use if he wants you to use the partial method of goodwill. So let's see how this works. Now, it's always useful in these complex group questions to draw up a group structure. Here, a reminder that T owns 90% of middle, purchased in 2006, and middle bought 60% of bottom in 2003. Now don't forget, we top control middle, middle controls bottom, so both of these companies are subsidiaries of T. And don't forget, everything we're doing is from T's perspective. We can also calculate what T's effective interest in bottom is by multiplying the 90 and the 60%, and that should allow us to work out the non-controlling interests for both middle and bottom. T owns 90% of middle, and therefore somebody else owns 10%. And T effectively owns 54% of bottom, so somebody else effectively owns 46%. We can also think about when these companies entered the group. Middle entered the top group in 2006. That's when top bought middle. But don't forget that middle already owned bottom at that stage. So if I was to ask, when did bottom enter the T group? Well, hopefully you can see that bottom also entered the T group in 2006. Not 2003, but 2006. So we can do our goodwill calculations for both of our subsidiaries in middle and bottom. Let's deal with middle first of all on the left here. Let's just make sure we're happy with these figures. When we bought middle, it cost us $400,000. So that's what we paid, $400,000. And when we bought middle in 2006, notice that's when middle entered our group, 2006. According to the table at the top of the page, middle would have had share capital of 60, and in 2006 they would have reserves of 210. Middle would have been worth 270. Now, as we're using the partial method of goodwill, the other 10% non-controlling interest is calculated based on the 10% that they own of the assets we just acquired. 10% of 270 is 27, giving us goodwill relating to the purchase of middle of 157. Nothing new there, that's a traditional goodwill calculation. What about bottom? Well, when we bought bottom, and of course we didn't actually buy bottom, it was middle that bought bottom, and middle paid 100,000. So middle paid 100,000. But let's just pause here for a moment. Everything we're doing here needs to be from top's perspective. And don't forget that we don't actually own bottom. It's middle that actually bought bottom. So actually, even though the group paid, a group member, middle, paid 100, it would be wrong to include all of that cost of investment in this goodwill calculation. If you imagine that middle raised the finance to buy bottom from its shareholders, we'd have paid 90% and non-controlling interest would have paid 10% of that investment. So I'm just going to include our 90% share of that cost of investment. Even though middle paid 100, that would have only cost me, top, 90. So what I'm going to do is I'm going to reduce our investment in bottom by 10%. That's the non-controlling interest percentage in bottom, don't forget, of the 100 that was the cost of the investment. Again, another way of thinking of this is that from top's perspective, top will have only paid 90 of that investment of 100. Okay, well, bottom joined the group in 2006, we've seen that. And in 2006, bottom would have been worth, well, it had share capital of 40, and in 2006 it had reserves of 110. Bottom would have been worth 150. And therefore, in the non-controlling interest line, don't forget, the non-controlling interest in bottom is 46%. Don't forget, we effectively own 54%. So to work out the non-controlling interest, I take 46% of that 150, which is 69, and therefore the final goodwill figure here is 9. Add them both together, and the figure that will appear on the group statement of financial position will be the total goodwill of 166. Okay, so notice those two goodwill calculations, and notice, I'll just highlight the things that people sometimes get wrong. Don't forget to knock off the NCI's investment in the subsidiary, and don't forget that the NCI percentage is based on T's effective own interest in bottom. Okay, what if I change the dates around a bit here? What if top bought middle, 90% of middle in 2003 and paid, let's say, 290,000? And what if middle bought bottom in 2006 and paid 120,000? Well, let's see how that affects our figures. Again, two goodwill calculations, but again I'm going to ask you, when did these two companies enter the T group? So again, let's think about middle. When did middle enter the T group? Well, that's when we bought middle in 2003. But what about bottom? When did bottom enter the top group? Well, hopefully you can see that we bought bottom, the group bought bottom, in 2006. And so notice these are the dates that are going to appear in our goodwill calculation. So, let's just go through these goodwill calculations again. When I bought middle, and I've noticed I have changed the cost of the investment here just so the figures make a bit more sense. When I bought middle, I paid 290,000. And I bought middle in 2003, which, using the table on the previous page, means that middle would have been worth share capital of 60 and reserves of 140. Middle would have been worth 200. Because I don't own all of middle, I only own 90%, the NCI will become 10% of the assets acquired. Don't forget we're using the partial method here. So 10% of 200 is 20, giving me goodwill of 110 on the purchase of middle. When middle bought bottom, well, middle actually paid 120,000. But again, don't forget that there is some NCI in middle of 10%. And if middle bought bottom, and imagine that middle is raising that money from its shareholders, the NCI would be asked to contribute some of that 120,000. In fact, 10% of that 120,000. Another way of looking at this is that I'd only be asked to contribute 90% of that 120,000, 108. Everything we're doing is from top's perspective. So I deduct 120 from the cost of the combination, or if you like, just use 90% of 120, it's the same number. Then I have to ask myself, what was bottom worth in 2006? Well, again, using the table on the previous page, in 2006, bottom would have had share capital of 40 and reserves of 110. Bottom would have been worth 150. Bearing in mind that the non-controlling interest for bottom is 46%, you'll recall the percentages are the same as they were on the previous page, then the NCI percentage of the 150 is 46% of 150. 46% of 150 is 69. So again, 27, giving me the figure which would appear in the group statement of financial position, 137. So there's a few little tricks and traps to be careful of there, but really we need to think about what is this company at the bottom of the chain. It's almost certainly going to be a subsidiary, and then keep an eye on the dates, the percentages, and the goodwill calculations there. But we'll practice this to get used to it. And so in the next lecture, we'll cover the lecture example 2.1.